Imagine this. Nvidia, the AI chip giant, just reported jaw-dropping profits. We're talking billions here. But instead of skyrocketing, their stock price took a nosedive. Shocking, right? Well, buckle up, because we're about to dive deep into this market mystery. I've spent days poring over financial reports, analyzing historical data, and consulting with industry experts to bring you the full story. By the end of this video, you'll understand why sometimes even record-breaking profits can't save a stock from tumbling. And trust me, what you learn might just change the way you think about investing forever. Let's bust some myths about stocks and earnings. Many believe that good numbers always equal a rising stock price. Sounds logical, right? Well, the market isn't always that simple. Long-term, yes, fundamentals matter. But short-term, it's a whole different ballgame. Emotions, expectations, and even rumors can send a stock soaring or plummeting, regardless of the earnings report. Think of it like this. The stock market is less like a calculator and more like a mood ring. It reflects not just hard data, but the collective feelings and predictions of millions of investors. Understanding this is crucial for making sense of seemingly paradoxical market moves. Let's take a trip down memory lane with two of the market's biggest success stories, Amazon and Tesla. For years, Amazon was the king of growth over profit. They poured every cent back into the business, often reporting losses. But did that tank their stock? Nope. Investors were betting on the future, not the present. Tesla's another wild ride. There were times when Elon Musk's electric dream was teetering on the edge of bankruptcy. Yet the stock kept climbing. Why? Because sometimes the market values potential more than profit. These companies proved that red ink doesn't always mean red flags for investors. It's a powerful reminder that the stock market often trades on tomorrow's promise, not just today's performance. Now, let's talk about Microsoft, the tech giant that defied conventional wisdom. From 2000 to 2016, something mind-boggling happened. Microsoft's profits soared, nearly tripling in some years. But here's the kicker. Its stock price went nowhere for 16 years. Imagine that, a company making more money than ever, yet investors weren't biting. During this time, Microsoft's stock even plummeted 75% at one point. It's like running a marathon, breaking records, but the crowd just yawns. This paradox shows us that sometimes, even when a company is killing it financially, the market might shrug. It's a stark reminder that stellar performance doesn't guarantee stock success. The reasons? They're complex, ranging from changing market perceptions to shifts in the tech landscape. Microsoft's story is a masterclass in why we can't always connect the dots between profits and stock prices. Let's zoom in on Nvidia's latest earnings report, the one that sent shockwaves through Wall Street. The numbers were, in a word, spectacular. Nvidia didn't just meet expectations, they shattered them. We're talking about revenue and profits that blew past even the most optimistic analyst forecasts. Their AI chip business? Booming. Data center sales? Through the roof. On paper, it looked like Nvidia had hit a grand slam. This wasn't just good, it was the kind of report that usually sends stocks soaring. But here's where it gets interesting. Despite this knockout performance, Nvidia's stock took a hit. It's like serving a 5-star meal and getting a 2-star review. This disconnect between stellar earnings and a falling stock price is what makes this situation so fascinating and potentially revealing about the current state of the tech market. So why did Nvidia's stock fall despite those jaw-dropping numbers? It's all about expectations versus reality. Think of it like this. Nvidia wasn't just expected to do well, it was expected to perform miracles. The market had already priced in extraordinary growth. When the results came in, they were amazing, but not the earth-shattering, history-making numbers some had hoped for. It's like expecting your favorite athlete to break a world record every single time they compete. Even if they win gold, some folks might be disappointed. This is the double-edged sword of being a market darling. The higher the pedestal, the harder it is to impress. Nvidia's slight dip isn't necessarily a reflection of poor performance, but rather a reality check on sky-high expectations. It's a classic case of buy the rumor, sell the news, a phenomenon that often catches new investors off guard. Let's step back and look at the bigger picture. What do these stock movements really tell us? They're not just numbers on a screen, they're a window into investor psychology. When a stock falls after good news, it's often a sign that the market is recalibrating its expectations. It's like adjusting the difficulty level in a video game. Nvidia's been playing on expert mode for a while now. The market's reaction is less about the company's performance and more about the sustainability of its meteoric rise. It's also a reminder that the stock market is forward-looking. Today's price isn't just about today's news, it's betting on tomorrow's potential. This Nvidia situation? It's a masterclass in understanding that stock prices are as much about future expectations as they are about current performance. It's a complex dance of numbers, emotions, and predictions. Now, let's talk red flags for Nvidia investors. While the company's performance is stellar, there are some warning signs to watch. First, the sky-high valuation. Nvidia's been priced for perfection, which leaves little room for even the slightest hiccup. Second, the concentration risk. A huge chunk of Nvidia's growth is tied to the AI boom. If that slows down, it could hit hard. Third, increased competition. Other tech giants aren't sitting idle. They're racing to develop their own AI chips. Lastly, geopolitical tensions, especially with China, could disrupt Nvidia's supply chain or market access. These aren't reasons to panic, but they're definitely factors to keep an eye on. Remember, in investing, it's not just about the current success, but also about navigating future challenges. Nvidia's riding high now, but staying at the top is often harder than getting there. So, what are the key takeaways for smart investing? First, don't equate good earnings with guaranteed stock gains. The market is complex, often pricing in future expectations. Second, understand the power of context. A company's performance is judged against expectations, not just raw numbers. Third, always look at the bigger picture. Consider industry trends, competition, and global factors. Lastly, remember that even top performers like Nvidia face risks and challenges. Speaking of top performers, if you're looking for another potential game changer in your portfolio, you need to check out my latest video on Palantir. This controversial stock is making waves on Wall Street, with billionaires like Ken Griffin betting big. From crushing earnings to expanding its customer base, Palantir's showing some seriously impressive gains. Plus, I dive into why it might even be recession-proof. Intrigued? Click the video in the end card to discover why Palantir could be your portfolio's secret weapon. Trust me, you don't want to miss out on this one.